Market Connect. Market is widely expecting US to hike rates soon. In the meantime, China has started the easing cycle. The world's two largest economies are clearly heading into the opposite direction in terms of monetary policy making. Unlike in the US, the economic condition in China warrants additional room for policy easing. There are a variety of types of rates available in China. It could cause confusion for investors to understand how each policy adjustment could impact market liquidity and the real economy. So in this week's video, we want to help you to understand the structure. The People's Bank of China, PBoC, is responsible for setting both short-term and long-term rates that have direct impact on money market, credits, and the government bond yields. PBoC usually leverage short-term injection to deal with special situations or to stabilize interbank liquidity conditions. For example, the open market operation or special arrangements like the temporary lending facility in 2017 and the contingent reserve arrangement in 2018 were all used to achieve this goal. At the short end, the 7-day banks-only weighted average repo DR007 is the key policy rate to guide money market rates, whereas the standing lending facility and the ceiling and floor of interest rates on excessive reserve are to mitigate excessive volatilities in DR007. During PBoC's January press conference, they stated the need to expand monetary policy toolkit, hinted a long prime rate LPR cut and a potential reserve requirement ratio, the RRR cut, to stabilize expectation. It is important to understand the LPR is not only an interest rate, but also a macro indicator. A change in LPR could have implications for all industries and the whole economy. The targeted RRR reduction, as well as an increase in the medium-term lending facility, will provide liquidity for smaller banks to boost lending to small business for sectors that are strategically important to China's next phase of growth. Total social financing is a measure of a broader credit growth. There are many components fall into the TSF growth. Entrusted loans and local government special bond issuance is one of the many. The Chinese government has emphasized credit growth should trend in accordance with nominal GDP growth. Market expects credit conditions will remain favorable. PBoC acknowledged the potential downward pressure in China's economy and suggested they would keep liquidity at a reasonable level through utilizing multiple available monetary policy tools they have. They also pledged to stay ahead of the curve and be responsive to market concerns. An accommodative monetary policy is not only to boost economic growth, but also needed to lift market sentiment and boost investors' confidence. This is Xiaolin Chen. Thank you for watching China Market Connect. I see you next week.